critical time to be in so that you can maximize your impact for all the people that you're serving or that you want to serve. So this would be for new clients as well. So we're going to get going right away. Again, thank you everyone for joining us here in this room. We're going to give you some tips. And I just want to tell you, I think RSPs are great. And you're going to come across people that say, no, I don't like RSPs. And so we're going to delve into, what you do, what you say to those people, what you show them to change their mind. It's probably because of an experience that they had. So we're going to talk about how to talk about them. And we're going to, we want you to be successful in this area of the business, and it's a great area to be able to help families. So we're going to talk about how to talk to prospects and then about clients, about getting their RSPs for the tax year of 2025. So, I think this is the easy part. Right now, you can just basically talk to anyone about, has anyone shown you how to get some of your hard-earned income tax back? Right? It's a thought-provoking question. So this can be for an existing client, or this can be someone that you're just starting to have conversations with. I wouldn't just go up to anybody in the grocery store and ask them this, although, you could if you wanted to. I just don't think you're going to have as much success if you do that. But start a conversation with somebody and then ask them this question, right? Because here's the thing. When people earn income, a lot of it goes to income tax. You see this guy making $85,000, and $21,000 of it was going to income tax. Now that's a lot of money that went to income tax, right? Do you think he'd be interested in some ways of getting some of that back? Because doing RSPs is one of the few ways that you can get some of that income tax money back. So this is an easy one, because I ask, and sometimes people don't even know how much they paid to income tax, and others they know, because they look at their pay stub and they think, oh my goodness, how could there be that much being taken off my check every month, right? Just to go to income tax. Well, are you interested in finding a way, in seeing a way in which you could get some of that income tax money back? Okay, that's an easy one. So another question I ask for people, this is not necessarily clients, okay? This would be for, approaching somebody. So have you bought your RSPs for 2025 yet? And you're going to get a multitude of answers, okay? Regardless of what it is, we're going to show you some of the ways to, talk about whatever their answers are. And like Glenn's question is right now, is talk to people about where's the money? It's a great opening question to have. So one of the things you can say is, so if somebody has $10,000 sitting there that needs to be invested that they haven't done anything with yet, but let's look at, what does $10,000 look like in retirement? Say this person's 35 years old, making $85,000 a year. They're in the marginal tax rate of 30%, 30.5%. Well, run those numbers for them, okay? It's so super easy to do on your phone, on the Primerica app, or if you're sitting at a desktop, you can do it this way as well. But, and I guess let me just jump back a couple minutes. Because if you ask this question and somebody says, no, I haven't yet, well, are you planning on it? Can I help with that? Can I show you an easy way to do that? Don't try to do a presentation and show them everything right in the middle of the grocery store or the gym or wherever it is you're at. Make an appointment with them. Hey, do you have time, later today or perhaps tomorrow evening, where I could show you some of the easy ways to get this happening for you, okay? And then show them. $10,000, if you get that invested, just the $10,000, say at an 8% rate of return for the next 30 years, because this person is 35 right now, so take them to 65, that $10,000 alone is going to grow to $109,000. So when does 10,000 become 109,000? I mean, it's kind of crazy when you run the numbers forward. And this is one of the things that I think I've had the most success with, because I'm very much a visual person too. Most people can't imagine what their little bit of money today is going to grow to in the future if they get it invested. Now, if they put it into an RSP, guess what's going to happen? They're going to get a tax refund, likely, right? So that tax refund at the 30.5% tax return, okay, they're going to get about another $3,050 back just from putting that 10,000 in. So we're in the last couple of weeks of February, they get their 10 in, and then as soon as they get their taxes done, it could be March, latest probably April, they're going to get that $3,000 back if they take and add that to their investment, whether it's to the tax-free savings account, set up a tax-free savings account for them, or whether it's to an RSP. I call this the double dipping, right? Because you're getting 10,000, you're getting something back that you didn't have before anyhow. So if you do it in an RSP, you're going to get that back. Add that to your RSP. Guess what that does? That adds another $33,000 to your retirement fund just from that one 3,050 deposit, okay? Getting it back from income tax. It's hugely powerful. Show them the numbers because they can start to dream and realize that it can be possible for them as well. And I don't think it really matters if you have, $1,000 to invest or 10,000 or whatever the number is. Show them because you're putting them in the driver's seat, right, of their numbers. It's their picture, right? So you can have a super amount of success with that. Oftentimes you'll have people say to you, well, RSPs don't work. No way, our RSPs don't work. Okay, and it's often from people who don't really understand how RSPs work. And I'm not going to go into the basics of it, but basically when you purchase RSPs, it reduces your taxable income. So after you purchase that, then it's tax deferred until it's withdrawn. Okay, and majority of people, okay, look at it this way. Most people want to have a pension plan at work. Well, RSPs are for people who primarily don't have a pension plan at work or who want to supplement their pension, right? So if you think a pension is great, you should think RSPs are great too. But when they say that, this is one of the things that Byron has taught us that has been super valuable to me because see, when somebody says they don't work, you know what I want to do? I just want to jump on them and tell them why they do work. I don't know, does anybody else feel that way? It's just that's my automatic reaction. But be curious. What do I mean by be curious? Ask the question. Oh, really? So why do you feel that RSPs don't work? And then they're going to tell you exactly why they think they don't work, because it's likely because of one of two things. One is they redeemed their RSPs because they needed access to cash. They had an emergency come up or something. Okay, they redeemed their RSPs. Well, they're at their highest income. So they pay the same tax on the RSP as what their marginal tax rate was because it's deemed taxable on top of your income. Okay, so it's in the highest tax bracket possible. So number one, bad mistake. RSPs are for retirement. They aren't meant for an emergency fund or for drawing money when you need it. Okay, that's the biggest mistake. People don't realize that it's going to affect them a lot and they're going to lose a lot of that money to tax. The other one is, sorry, I don't have the title right here. Number two is not first home savings account. Okay. Number two is some people have experienced this and then they tell everybody about it. And so this is why some of this RSPs don't work the rumors spread. So let's imagine you have the death of a last surviving parent situation. Okay. First parent has already passed away. Second parent now is passing away. The children were selected as beneficiaries. Okay. On this RSP or RIF account. The fund company issues the full amount of the funds to the beneficiaries. They don't withhold any income tax. So say it's 300,000 and there's 3 kids. They each get 100 grand. Okay. But guess what? There's a tax notice sent to the estate because is there tax owing on that RSP if you redeem it all in one day? Yeah, it is. So the day that person passed away, there's a tax bill due on that. Okay. Because there's no spouse left. Otherwise it would just roll to the spouse as part of the spousal privilege. So the tax notice is sent to the estate. Then what has happened, and I've experienced this through some of my clients, that then the CRA comes after the children, requiring some of that money back to cover the tax. Okay. And guess what? They might have already spent that 100 grand. And yet CRA always wins. So I had a conversation with one of my clients who's a lawyer in Manitoba, and he said CRA always wins. There's never a situation where CRA is going to say, oh, the money's already gone. I guess we won't try to get it. No, they're always going to win. So one of the best ways when you have a parent that no longer has property anymore and just has RSPs or RIFs likely, just has RIFs left, that a portion of that is made payable to the estate. So at least covers the income tax, so these children aren't in this situation. Now, when it's happened for me where the children, get this payout, I advise the children, okay, CRA is going to require a portion of this back for income tax. Okay, just prep them, make sure they set it aside. You can help them figure out what that amount is so they make sure they prepare so that when CRA comes calling that they're prepared. Okay, so these are usually the two reasons why people don't think RSPs work. Oh, and the third one, I didn't think of putting this one in here, is that they had an RSP, say at the bank, and it was either not invested or it was invested in really low rates of return. And so they think it doesn't have growth. Okay, but it was just not properly invested for them. Yes, the RSP was set up, and yes, there was money in it, but it wasn't invested in the proper with the proper tools. So those are usually the two reasons why people say that. And so rather than jumping on them and telling them that RSPs are great and they should be doing them, find out why, because it might explain where they're coming from, and then give them a solution to work around that. Okay, so reducing your taxable income. RSPs reduce your taxable income, and I'm going to give you one of the tools to be able to demonstrate to them how that they can get back some of the income tax money that they already paid. So we're in the first 60 days of 2026. Any RSPs that are purchased in this time frame can be used against people's taxes for 2025. Okay, it's a sweet spot to be in. But let's not confuse it with the first home savings account. The first home savings account also reduces your taxable income. I love the program, and I think everybody that doesn't own a home yet should be doing one of these. However, the tax benefit is only able to be applied to your income tax return in the year that it was purchased. Okay, there's no first 60 days carryover into the next year. So don't be setting up people with a first home savings account and a lump sum with the intent of accounting for last year's income tax, because it's not going to work that way. Okay, I made the mistake last year, and then after we set it up, I'm like, oh shoot. Okay, so we had to set up the RSP and get that money properly allocated into the RSP instead of the first home savings account. And I tell you this because I've made the mistake. And guess what, guys? The more you do, you're going to make mistakes, and it's okay. They're all fixable, and you're going to be able to get the right things happening for your clients. Okay, so one of the tools, I don't like Wealthsimple. Believe me, I'm totally against Wealthsimple. However, they have a really great calculator online. It's called the income tax calculator. So it's wealthsimple.com/calculator. And I'm just going to show you a couple, and then we'll actually go to the calculator at the end of this talk this morning so that you can see where to find it. Clients have asked me for this as well. It's a public website. You can send it to anybody you want. But for instance, okay, somebody in Saskatchewan that's making $60,000 a year, and last year they made $60,000, and they have $5,000 that they want to put in. Guess what that shows them? That they are going to be able to get back likely from their income tax. And don't tell them that's a guarantee, because they may have other factors, like maybe they have some part-time income or something, that their income tax bill is higher than just from their income. So you want to be careful that you don't just, promise things. But estimating they could get back somewhere between $1,400 and $1,500 in income tax by doing this $5,000 contribution. Who else is giving you $1,400 or $1,500 back just from doing the right things and building your future, right? Well, this person is in the 27% tax bracket. So their after-tax income from doing 60,000, by the time we subtract the federal and provincial income tax and then CPP and EI, they're making a net of about 47,000. Okay, so this is a really quick, simple way without any other factors. I'm also going to show you the AGF income tax estimator. Okay, and I'll show you where to find that. And we'll go to at the end of the program, we're going to pull it up because you can have it saved just as a bookmark just for this. So it's easy to go to. So again, these are Saskatchewan income tax. By the way, Saskatchewan pays more income tax than Alberta. So if you're in Alberta, do a little happy dance because you're not having to pay as much income tax. But for the year 2025, this same person that's making $60,000, okay, they're single, don't have a spouse, and they're between the ages of 18 to 64, and they're healthy. They don't claim the disability tax credit, okay? This is going to tell you that the total tax payable, okay, is $8,136. Just from their income, that's how much income tax should have been off there, okay? In this case, we are getting them a refund of $1,473 because what? Because we are, I don't know what I put here. In this case, I made them No, I didn't make them disabled. I checked off that they were disabled. Okay. I didn't make them disabled. And they have a disability tax credit of 10,138, right? Which gets them back additional money at income tax time. So you could talk to them about doing their T1 form with their employer so that they get more of that money back every year or they have less income tax taken off their payroll every month. Okay. And then this one, you can have, let's say this one is a $4,000 refund. How do we get that? Well, we get that because we have I don't have the right screens on here. Yeah, here we go. You're going to get them back $6,700 because they've got one child who's under 6, okay, or they've got 2 children under 6, and they're going to have dependent tax credits as well. So you're able to refine it a lot more than the simple calculator on the Wealth Simple website. Okay, and we're gonna take some time for questions in a bit here. So Lisa's going to help me with that, but I know there's probably some questions popping up, so we'll make sure you get your questions answered. One of the things that I want you to really be careful of, and again, I've learned from experience, ask to see their notice of assessment. They're saying they want to put in so much money into RSPs, that's great. Do you have the RSP room for it? Can I see your notice of assessment? Because I want to make sure we have this room. It's a real big hassle if you over contribute. So this is one of my clients that over contributed to their RSP by $20,000, $20,700. And here's how it went. He said, so they were in the process of a move, all their tax documents and stuff were, in boxes, etc. And I asked him, how much RSP room do you have? And he says, at least 50,000, maybe more. Okay, so we put in 50,000. Guess what? He didn't have 50,000 of room. He only had 29,300. So he ended up getting this over contribution situation, which they get a notice from CRA. And because everything's on email now, they don't get the notification in the mail. It comes as an email to their My CRA login. Okay, and there's going to be penalties and interest. So CRA is going to charge you like 1% interest per month on the amount that you over contributed. Okay, so this is not a great situation to be in, and you can avoid it by just getting to see their notice of assessment right up front. So this person, I asked to see their notice of assessment. They have 113,000 in RSP room, which guess what we used because we were transferring their pension and they had some non-locked in RSPs that you had to have RSP room to move it into. So you're going to, again, this is one of the biggest things I could say, make sure you ask them to see their RSPs. Back to this one, if they had, so this said that they had purchased the 20,700. If it was available for 2025, it would have not had these brackets around it. But because it's got these brackets around it, it means they actually don't have the room. They over contributed. So I'm sorry, I didn't explain that very well. But I encourage everybody, clients and everyone, to make sure you get logged into my account on my CRA. Okay, and it's easy to register for it now. Okay, even elderly people can register for it. You just have to have an email address, and they've made the registration process simpler. So it's super easy to sign into the account once you've got the registration, your registration is being approved. However, don't go there today because today CRA, most of my account on CRA is offline due to some system maintenance upgrades. So from 3 o'clock this morning until 5 o'clock this afternoon, Eastern Standard Time, you're not going to be able to log into here. So after I just told you all that, don't try to log in today or tell your clients because they're not going to be able to just for today. The other thing that you're going to see is your clients and everybody you know is going to be bombarded even with emails from all the banks and everyone because everybody's trying to get that piece of money from everyone, right? So one of my clients got this week. This is encouraging him to do an RSP loan with RBC for $15,000 at RBC prime rate plus. Okay. So this is what he got. He sent it to me. Should I be doing this? So here's what they show here's what they show. They always show the best case scenario, not the scenario that most people are in. So this is showing this client being in a 40% tax bracket. He is not in a 40% tax bracket. So what he looks at this and says, oh, doing $15,000, I'm going to get $2,000 back. And they're saying, well, you're going to still pay interest because it's a loan of interest of $75.73. Well, this is only on a 12-month term. So this means for him to take out 15,000, he would have almost 1,300 in monthly payment. Probably not doable for a lot of people, right? So, and it's not just straightforward. They just give you the best case scenario, kind of like something to draw you in so that you would, hop on this. Okay, so you're going to have this. We do have an RSP loan program as well through BTB. We haven't used it in the last couple of years. It's just not been as good as it used to be in previous years, especially with prime rate being just a little bit higher. Okay. Now, this is the other one that sometimes people say, I don't want to do RSPs because you'll lose all your RSPs to taxes in retirement. So I want to show you the tools that you can use to, again, be curious. Oh, really? How's that? Why do you say that? And they're going to tell you because somebody, redeemed at the wrong time usually, or they're under the misconception that whatever tax bracket I'm in now, when I take out my RSPs in retirement, it's going to be at the same income tax rate. Well, let me tell you, folks, it's not. You can plan for it so that it's not. So again, if somebody's redeemed their RSPs when they're working, they think that they're going to have that tax rate when they take out their RSPs or when they're in a RIF drawing process or PRIF or LIF drawing process. But the RSPs are meant to be redeemed when you're in a retirement phase, not a working paycheck phase. Okay, so I'm going to give you an example. So one of my clients, her LIRA account is sitting currently at about 705,000. This is when it started in AGF. Okay, it shows you up here in the top right corner that the start amount was 375. We'd actually had it at dynamic for a doubling period as well. So it was about 189,000 when it came over from teacher's pension in Alberta. Okay, and it's sitting at 700,000 now, and it's done well. Okay, because we've got it invested in the right thing. It's not sitting in some type of GIC or something in her LIRA account. Okay, so what I want to show you this is AGF has a fantastic RRIF calculator. And I think you should use it, even if you don't have any clients who are at the stage where they need to be converted to RIFs yet. I have a lot, okay, and I have a lot of clients that are within 10 years of retirement, and they want to see, and I want to show this to them because I want their fears to be allayed that taking out RIFs is going to be super simple and easy and cost effective, tax effective as well. So what you enter into the RIF calculator, and I'm going to show you exactly where to find it on AGF. Again, it's super simple. The RIF calculator, this is just showing, okay, the start balance is 705,000. We're doing an average expected rate of return of 8%. Her stuff with us has done over 12%, okay? So it's all in equities. And she doesn't want to change from that. Okay, she was born in 1961, so that gives you a little bit of an idea. She's 65. Now, I want to show you this because it's going to tell you that 700,000 is going to pay out a total of $3 million if you just select the minimum payments on the RIF. Okay, when does 700,000 turn into 3 million? Like the power of having these RSPs or RIFs, RSPs or pension turned into RIFs or PRIFs. I mean, it's amazing. So look at this. So this gives you all of the detail, and you're able to. Here's what I would tell you: don't just tell people about how it works. Show them. Because seeing is believing, and when they see it's their numbers, I tell you, they're going to ask to see this multiple times. Every time you come back to review, they're going to say, "Can you show us that again? What's the numbers now?" Right? Okay, so this is part of it's you set the F&A up for them, but then you want to show them how exactly the withdrawal is going to work. So at age 65, so I selected as it being a new account, so it starts for the next year. If I'd selected pre-existing account, and I'll show you where to see that. If I'd selected pre-existing account, it would have started for January this year. Well, the CRA has a percentage for each year of age that you are that you must withdraw from your investment from your RIF for that year. So at age 65, you have to withdraw. If it's in a RIF, you have to withdraw a minimum factor of 4%. So 4% of 757,000 is $30,000 for the year, or monthly is 2526. Now, because you're just asking for the RIF minimum, there's no withholding tax. Doesn't mean it's not taxable. It's still overall taxable income. But guess what? They don't take a chunk of your money to put it to tax every month. Okay. You get to take out the full amount on the minimum, and then you're going to pay tax at the end of the year. Okay. But we can plan for that. We can plan for that either through your tax-free savings account, or we can make a one-time withdrawal just to pay the income tax if at income tax time you need to make a payment. Okay. So this is just showing you that every year that you age, the percentage rate goes up by a little bit. It's only 0.17% to the next year, but you can see by age 80, you're at 6.82%, right? And okay, your investments are making 8% and you're only taking out 4% that first year. Guess what's happening? Your balance of the total account is growing because you're not taking out more than the interest rate or the rate of return on your investment. Okay, so this is why at age 80, now they've got 1.1. They started out, right, with 700,000 and they've been taking out 30, 40, 50, 60, $70,000 a year. I mean, this program is amazing, right? And by age 95, the government's going to require that you take out 20% of your total account. Why is that? Because by age 100, they want it to be completely emptied. Most people don't make it to age 100 anyhow. What's the average lifespan for women? Well, for women, it's 86 years old, and for men, it's 83. So even if this was a male, even by age 83, there's still $1.1 million in there. You started out at 700,000, right? So it's really an amazing program. When you log into the AGF website, you go to the education tab, click on registered plans, okay, and then RIF income funds, okay, and click on that. That then takes you to the RIF page, and scroll down all the way to the bottom in purple is the RIF calculator. Click on that, and just a reminder that RRSPs get converted to RIFs, okay? However, LIRAs in Saskatchewan gets converted to a PRIF. LIRAs in other provinces might be a LIF or a locked-in RRSP account. You're going to have to find out exactly what that's going to get turned into. But I want to just tell you, you guys can have a super impact on people on building their retirement portfolio and helping them navigate all the ways to make the best efficient use of this. But just by showing them what their money is going to grow to in the FNA and then helping them keep on track, you're going to have people that say, thank you, thank you, thank you for showing this and making it so simple. I have people that call me all the time and say, can you walk us through what it's going to look like once we start withdrawing our RSPs in retirement? Absolutely. You're happy to do that because you have the tools to do that. And I just want to tell you, you know what? You have 17, this is thanks to Sally for making this up for me. You have 17 days left of the RSP deadline. 17 days. When we first got started, this is what our focus was. Get as many people as possible doing RSPs. And maybe they can't afford a lump sum now. Get them on a plan so that throughout the year, they're putting in $100, $200, $500, $1,000 a month, right? So you can totally do that. And I'm going to stop sharing my screen. We'll just see quickly what the questions are at this point, if there's any question. And then I'm going to show you some of the tools.
Hi, Jan. Jennifer Cook has asked, can you decide which percentage you want to take as long as it's at least the minimum?
Okay, so that's a really great question, Jenny. Thanks for asking that. If you ask for the minimum, it's going to be set on the government percentage for that year. You don't get to decide. If you decide that you want $10 more than what the minimum amount is that percentage gives you for the month, you're going to have withholding tax. Just click even just $10 more. You have to go with a minimum if you don't want any income tax withheld. If you go more than that, it totally shifts it out of minimum and it's going to have a tax withholding for you. Great question though. Thanks, Jenny.
Great question. And That is the only question we had on the list the whole time.
Okay, perfect.
Amazing information.
Now let's go and show you some of these tools so you can see exactly how they work. I'm going to share my whole screen this time, so hopefully that doesn't mess it up with the Zoom bars and everything. Can everybody see this okay?
Yep, it's
Okay,
great.
so this is the Wealth Simple tax calculator. Okay, so you get to choose the province that you're wanting to show, whether it's Saskatchewan or whether it's Alberta. Just you can't go further until you select the province, because guess what? Every province has different tax rates, and you get to choose the employment amount or the self-employment amount. So let's say this person made 65,000 net. It's going to tell you exactly how much income tax and CPP they're going to owe. They won't owe EI, but they will owe CPP, both the employer and the employee portions of CPP. Okay, so let's say they have $15,000 to put into income tax or into RSPs. Guess what? That's going to keep them from having to pay a total of the income tax. What was this before? Let me just go back here. They're having to pay a total tax of 16,388. You put $15,000 into RSP. Guess what? That drops it down by 35.91. So they're not going to get this money back because they are self-employed. However, that's going to prevent them from having to pay the full 1688. If we take this and they didn't make any self-employed income, let's say they were at an employment where they got a paycheck, doing that same 15,000, they're going to get $3,883 back on income tax. Okay. And if you want to show in here, well, actually the tax that I paid was, let's say they only paid $4,500 in income tax. They're going to tell you, oh, you have an estimated balance owing of 1348. Okay, so you can play with this. I can put the website in the chat if you like, and just make it easy for you to be able to return to and play with yourself. Okay, so it's in the chat for anybody that wants to see that. And then
Perfect. We do have
then the
another
next.
question, Jan.
Okay, great. Mhm.
Rose, she says, for people who are catching up on their RRSPs, getting close to retirement, is it worth it to do more RRSP rather than maximize the TFSA?
That's a really great question. Thank you, Rose, for asking that. My question is to you is, do you want to get the minimum back that you paid in income tax, or would you like to get the maximum back that you paid in income tax? See, if I have $10,000 to invest today and I put it all in tax-free savings account, good for me, 10,000 in tax-free savings account, but does it get me any of my hard-earned income tax back? No, not at all. So my recommendation, which I've stood by since right from the very start, because this is what we were taught, is maximize your RSPs. The tax return that you get back from that, guess what? You can take and put that into tax-free. Okay, so you're funding both, but you're double dipping and you're getting some of that hard-earned income tax money back. Rose, is that answering the question for you? I don't know if Rose can unmute herself. And okay, now just back on that question again, just one little thought here is that the RSP getting close to retirement, they're probably in their highest income earning years, which means that they're probably paying more income tax than they've ever earned before. So at this stage, it's even more critical that we get some of that hard-earned income tax money back and then show them putting it into a tax-free savings account so that when they do the drawdown, which reminds me, there's something else that I should have showed you that I haven't yet. I'll see if I can pull it up. Okay, so let's go. How much time do we have? Only 21 minutes. Holy. Okay, so let's go to the income tax estimator on, whoops. Okay, let's go to the income tax estimator. If I can get back out of this screen, let's go to the income tax estimator on AGF because it's really, I think, really huge for being able to show people exactly what those other options that really the Wealth Simple calculator doesn't do. Okay, so this is the income tax estimator. When you log into AGF and you first log in, all you do is just go to the very bottom of the page and it's on the right-hand side. We're going to do that really quickly, but here I'm just going to show you quickly on the income tax estimator how easy it is to navigate on here. So let's make this person making $65,000 again, $65,000. Okay, that tells you right away. Okay, now let's see. We're healthy. Yep. In Alberta, they're going to have a total to pay of $97.32. Okay, so, and let's add a child in here. So now they have one child. Well, the first thing it tells you is like, oh, the Canada child tax benefit for them at this income with one child only, they're going to get $4,800 throughout the year. So that's about approximately $400 on income tax or monthly on the child tax benefit. Now, if we take and say, okay, that child is under, let's say this none, but one under six, the rate is more. Oh, I guess I have to say this, it is under six. So that child under six is going to be $6,114. Okay. So it's just that much more. Okay, so then let's go to deductions. This is where you're going to put in, okay, have they contributed to an RSP or have they contributed to a first home savings account? Yeah, they put in $10,000 this year. So we're going to put that $10,000 in and let's go back to the main screen. Well, hang on a sec. Let me just go back to deductions and take this out because I want to see how much, let's say they paid the right amount of income tax on their payroll. So this is 5607.73. Whoops. There we go. Okay, they're not getting anything back for a refund until they put in $10,000 into their RSP. Then it would look like this. You can tell right away that they're going to get $2,700 back from income tax just from putting in that $10,000. It also allows you to show whether they get the disability tax credit or not, which is really huge as well. Because doing that, all of a sudden they went from $2,700 to $4,600 back at income tax time. So you're able to do this and use it in a number of various situations to be a little more, and you can print this off, okay? You can clear the data, start with somebody else's numbers, or you can print the summary and print it off for them. I always say, I'm not an accountant and I don't have the tax program. This is an estimator only. You'd want to check with your accountant or the person that's doing your income tax to see what it actually shows for you. But guess what? We have 17 days, we can make that happen, right? Okay, let's stop share. Do we have another question?
Yes, we do. We have a couple in the chat. So Catherine is asking which line is the earned income on so we know what to base the 18% on. Oh, Sally mentioned or answered that already. And Tracy asked about the loan calculator, the RRSP loan calculator. Could you show us how to find the tool to see if an RRSP loan would be beneficial or not?
Okay, so that's not on the AGF website. You'd have to go to the B2B bank website. And I actually have, can I just come back to that one? Because I'm on the AGF website right now and I want to show you that before it times out, but we will come back to that question.
Sure.
I'm just going to share my screen here again. Thank you. Okay, let's go to the AGF website. First thing I just logged in. If you scroll all the way down to the bottom of the screen, here's your income tax estimator right here. So when you first log in, easy to go to. It's also got the big picture handout here, which I think is really cool to be able to show people what investments have done over time. And this is also the 2025 big picture. So it's the most current. So when you click on this, you're able to, and it's like, you can download it. We used to pay for this, and it's a free service now. So let's go here. I want to show you going to the education tab on the registered plans and the RIF calculator, because I just think this is something you should play around with so that you're able to familiarize yourself before you actually have to use it. Because if you have to use it and you're trying to figure it out at the same time, you're not going to feel very confident, and you're also not going to look very competent either. So let's do this one. This client has 705,000 in their RSP that they're going to turn into a RIF. We're giving them an 8%. And it might be 6, it might be something else. You do it for what's appropriate for that client. And this is where you say, okay, we want to take just the minimum, or do we want another amount? Well, you might want to find out what the minimum is first, and then you can come back and calculate if we want to take out $10 more than that, what it's going to show like for tax. Okay, so we want the payment frequency to be monthly. You could choose annually. I have some people that are on annually. And let's make this their year of birth. Are they a Quebec resident? No. And are we wanting a new account, or are we showing for this year? So then we're going to calculate that. So what this does is it calculates it, and it's not in a very good like screen. I always go the print, which just makes it into a PDF so that you can actually see it. Okay, so and then I'm just going to make it bigger so we can all see it. This is what it looks like. So you can show this, and I've saved these for clients that I've done it with. So I remember what I showed them last time. Remember the actual parameters that we used, and this is what it's looking like. So 4%, this is exactly what I showed you guys, okay? And you're going to be able to see, okay, and this is going to show you, we're going to take more and more and more and more of it, right? Until we're going to deplete it. So that's how you can generate that. If we want to go back here, and let's just say they want another amount, and their payment per period, they want $3,000 a month. And I think this is really powerful. Jenny, this is speaking back to your question. We're still using all the same parameters. Now we're going to calculate that, okay? And did I have that right? Yep. Okay, then we're just going to print it. Now you're going to see what a difference it makes to go from the minimum to, oh, look at this alone. So that said, it said before that they're going to take over, they're going to generate over $3 million, right? From this 705,000. If you're taking more than the minimum, there's going to be some years here where the actual amount, okay, this is something, we didn't do something right here. Pardon me, let me just go back in here. Another amount of, oh yeah, so let's make it say they're wanting to take out $4,000 a month instead, and we're going to put this to monthly, okay? So now we're going to recalculate this. And now you can see now there's going to be tax withholding. So let's just make it print so it makes it bigger so you guys can see it as well as me. And we're going to make it bigger on the screen here. So what's going to happen is they're going to result in a lot less of their investment because they're putting some of that to income tax right away. So at age 65, taking out $4,000 a month, okay, that's the annual amount. The withholding tax on that is $5,300. So instead of 4,000, they're going to be at 3,554. If you have somebody that's totally can't stand if they have a bill to CRA at the end of the year, then this is what you do for them. Okay, and you can totally figure out what it's going to be. Now, if you're asking for $4,000 a month here, how come all of a sudden at age 73, there's no withholding tax? Well, it's because that $4,000 a month is less than the minimum that they're going to be required to take from the RIF because of the percentage calculation for that year. So that helps you to figure that out. Okay.
Jenny has another question for you.
Okay.
She says this is a loaded question, but if someone has maxed out both TFSA and RRSP, they also have a non-registered account, what would you recommend the redemption plan be for someone in retirement?
Oh, that's a great question. Okay. I've always played with the numbers to try to figure out what is it. And let me tell you this, what I found out is that the best place to take it from first is, so if they're not at age 71, and this might be contrary to what a lot of teachers have taught out there, but we use SNAP projections, which is a paid program for figuring out once you're in retirement, where you can take money from to be most cost effective, tax efficient. Okay. And it shows we're going to withdraw all of the non-registered first, because what is it? Well, tax-free is the most tax efficient because there's no tax on it. But the next one down is the non-registered because it's capital gains tax. Capital gains only on the income that it's earned, or the interest rate or how much it's grown by. So I don't know, Jenny, this might be a situation where you just have to run those numbers, but usually it's taking it from the non-registered first.
Wow.
Okay.
Um,
And
we
any
have
other questions?
yeah, one more question. We have 10 minutes.
Okay.
Catherine, another tax deduction question. There are strategy to use your line of credit to pay your mortgage on your home, not a rental property. Then deduct the interest from that loan to reduce your taxable income. I heard about this online, and it may be referred to as a Smith maneuver.
Yes, I've heard of that as well, Catherine, but I have over 1,000 clients and a lot more contacts than that, and I've never ever seen someone actually using it. So is it a maneuver that you might be able to use? Maybe, but that's not the one that I'd recommend. Um,
We do have some personal experience. We have a good friend and his parents used it and they lost their home on Kalamalka Lake in Vernon, BC, and had to go back to work, both of them.
wow. Okay, that's terrible. I'm so sorry to hear that. Catherine, I
Yes.
guess that's your strategy. There's always new strategies and stuff out there, but really when mortgage rates are as low as they are now, like I don't think you need to do any fancy maneuvers to to achieve what you need to achieve. I'm going to show one more presentation here that I should have entered put into my presentation today. And this is one thing that I show people um, why I want them to be building so it's for a couple family, and why I want them to be having kind of similar amounts of RSPs instead of just all in one. Okay. So this client, but oftentimes people say, but if I do RSPs, I will have so much tax to pay. Well, I'm going to show you how that's actually not necessarily true if you do strategy. So I talk about this as being a strategy to reduce your tax for retirement, okay? And this is using old tax rates. It doesn't matter, it's the theory or the concept of it. So if you have one person going to withdraw $60,000 a year in retirement from the retirement funds, there can be taxed income on the whole thing. Because when you take money out from an RSP, it's all considered taxable income. Okay. So on $60,000, this is Saskatchewan income tax. They're going to pay about $12,000 in income tax on the 60,000. Okay. Sounds okay. Now, I want to tell you that, like my parents' generation, it was very common for there to be only one income earner in the family, and and he was the one that had all the RSPs because they came from maybe a group plan or something. Okay, and the other spouse didn't have any income and no RSPs. Well, what happens is they're in the highest income tax bracket then. If you split that $5,000 a month income that makes $60,000 a year, and take that from two 2,500 a month withdrawals. So instead of 5,000 from one RSP, you're taking 2,500 from his and 2,500 from her RSP accounts. Then it drops the tax bracket by a lot. Okay. Instead of paying $12,000, they're going to be paying a little over $7,000 in income tax because they're drawing down from two RSP accounts at lower tax rates. Okay. So that reduces the tax bill by 41%, just that one little maneuver. You're going to get a ton of clients just from showing this right off the top, right? Okay. So then we've got another part to add to that to make you even more tax efficient. So let's say you have his RSP account and it might be a spousal RSP account because you help them set that up so that they could, even out how many investment accounts, the balances of the investments accounts are going to take 20 out of each from that 60,000. So that makes $40,000. And then out of their tax-free savings account, withdraw the $10,000 from the tax-free savings account from each of them, which are not taxed. So then it looks like this. So from that $5,000 retirement income, you're going to take 20 from the one RSP, 20 from the other RSP, and then 10 from each of the tax-free savings accounts. Now they're paying a lot less income tax. Now they're paying like $2,000 in income tax instead of $12,000. Well, that's a $10,000 a year tax saving. Now we're not factoring in things like like CPP and old age security. And that is a separate factor, and we can show that another day. But I want to just show you how this is so important to show them. You know, $10,000 a year in retirement, that is like $800 a month. That's like a high vehicle payment. That's like a mortgage payment, right? So what does this allow them to do? This allows them a lot more flexibility either on income to live on or amounts that they take, right? So that's really huge. So again, set up 4 strategic accounts for them. We do want to use the tax-free savings account totally in their whole plan because that can help reduce the taxable income that they have to pay. You know, might be in this example, like from $12,000 a year to $2,000 a year. So that's really, really a big factor. Okay. Did that prompt any more questions?
Yes, lots of chat. So
Okay.
with Tracy, so with withdrawing, do you go non-registered, then TFSA, then RRSP?
Okay, that's a great question because a part of what's going to be a factor is what their age is. Because at the end of the year in which they turn 71, they have no choice, but they have to convert their RSP to a RIF. So at that point, they're going to be required to start withdrawing from their RSP. But they can do a blend then of the monthly amount that they need, a blend from the RSP and the tax-free savings account that's left. Does that make sense?
I'll see if there's any other questions. There's a bunch of chatting going on so I'm looking.
Okay, so somebody asked
Ken,
Zayn, what about
oh, so
Zainab's question?
yeah, I was just about to read that. There was a bunch of other stuff going on. I was trying to find it again.
Okay, so can a client borrow from their RSP account? Does anybody know what the answer is to that? Unmute yourself and pop in if you do know what the answer is to that. Okay, if you can't borrow from an RSP account, the banks won't even lend using the RSP accounts as collateral. And why is that? Because there's tax owing if you take any money out. So if you, and I know I've heard this strategy before too, but no, it doesn't work because you can't borrow against, you could borrow against non-registered money. Okay. There's no tax implication there other than the capital gains part, but you can't borrow from an RSP account. You can borrow money to put into an RSP account, but you can't borrow from the RSPs once they're there because any taking of that money out is going to trigger a tax event.
Looking to see if there's any more questions.
Jan, the last one that you were showing, is there a tool for that? The last one where you're talking about, splitting the redemption and everything?
No, that I made up myself.
Got it.
So it is not, sorry, it is not a tool that's readily available and the numbers need to be updated, but you can make your own. Super easy to make your own. For sure. And then it'll be your ownership of it and you'll understand it too by putting it together. It's just like 6, 8 slides. Go ahead and do it. It's super easy to do.
Thank you.
And quick question. I was
Yeah.
I was using that calculator to help a client figure out how much they needed to do in RSPs yesterday. And I found the numbers wasn't working out. Like I had the income, I had the taxes, but I was finding that there was like a huge refund owing. In a situation like that, obviously we're not accountants, so I can't drill down, but would you account that to the fact that they worked a lot of overtime? Would that might be the reason why? Or is it just a
Oh,
glitch?
I don't think so, Jen, because on
Yeah.
overtime, you're still charged the income tax owing for that. Like
Yeah.
CRA doesn't care whether it's overtime or whether it's part of your salary. It's based on the numbers, so the income tax is going to be levied on that. So I'm not sure what it would be on. It might have been just it might have just been one of the check marks was checked off.
I'll have to take a look at it again. I'll send you a message on Facebook later. Thank
Sure.
you.
Yeah, no problem. Thanks for asking the question.
No worries.
And I think we're almost out of time. If there's any questions at all,
We have 53 seconds. You're awesome, Jen. Thank you for
Thanks for your
sharing
help. I really
all
appreciate it.
your skill. All your skill. We're grateful. We're grateful. So much information. Do it again. Happy
Awesome.
to
Well,
help.
thanks everyone for
Thank you,
thanks.
Jan.
Thank you so much for joining today. Hopefully you got, you know what, hearing training, you're just going to hear one or two little things that maybe prompt oh, I should go and talk to that person that fits that situation. If it's even worthwhile for one situation, then absolutely, we're happy to share with you. We're just learning, we're just teaching, or we're just sharing with you what we've learned through experience. And I hope you get to experience it all too. We want everybody to build their $10 million book of business as quickly as possible, get you in the higher trail commissions, and life becomes so much easier. So great job, everybody, for showing up, and thanks for joining our room this morning.
Thank
Jen,
you,
that was a
Jan.
master
Thank you,
class.
Jen.
Killed
Thank
it.
Can I ask a quick question?
you.
Absolutely, for sure, Rebecca. Yes.
So the I guess employer match,
Yep.
that's where they would be best suited, is just to put that into their group RSP. They're matching it.
Yes. Yes. If it's in a good plan, if it's not, then I'm going to have the extra. I'm going to set them up with a plan on our side. I want them to get the match as much as they can, but the match is only good if they're in a decent product. I don't want them to doing a match where it's not actually invested, because long term, that's not going to benefit them. Does
So
that
how
make
do we
sense?
find that? Yeah, for sure. How do we find out exactly? Like they would send them a
Okay.
fun fax?
No, you just get a statement. You can find out what funds that they're in then, and then
Perfect.
you can do then your search to find out, okay, what have these how have these funds performed? That's one of the ways you can help clients the most, is even with their group plans. People are often in a default, like a balance fund in the account that they're in, just because it defaults at that. Help them go through and select what they should be in. Okay, you're gonna help them a lot, even with that portion that you don't have any control over, but just help them get properly allocated, even in the RSPs that they have through work.